Hello, everyone, and welcome back to the PetroNerds podcast. This is episode 95, and it is a very special treat. Today is September 1st, Friday, 2023, and super special treat. My guest today is Chris Atherton, the CEO of EnergyNet. So, Chris, welcome to the podcast.
Yeah, thanks for having me. 94, we're closing in on 100.
Yeah,
I
I
like it.
know.
That's awesome.
Yes, it's a good
Great,
number. I
great,
like
great
the
podcast. I've always been a listener and always enjoyed it. Always good topics and good conversation. So really pleased to be a part of it today.
Thank you. Yeah, no, I'm really pumped about this. So this is it's Friday. It's September 1st, 2023, and I say this in front of every podcast, and I'll timestamp this, but we do kind of have. I mean, we're sitting at $85 WTI, so lots going on in sort of the global economy and in the global oil market. But you and I met at I just had Dan Romito on the podcast, met a lot of these people at this Oklahoma Petroleum Alliance meeting, and I saw you speak on a panel with NGP, and this was not Chatham House rules, so I don't think I'm disclosing anything. So there was a partner with NGP, and you were on this panel, and the conversation was very interesting, and really struck me in terms of some big takeaways, which I would like to get into today, which is access to capital and this massive sort of ESG pressure that's been on the industry. So there's a number of things I want to cover in terms of what you see as EnergyNet. And you can describe it a little bit to listeners as well in a moment. But if listeners aren't aware, I mean, EnergyNet, you probably, if you were in the E&P space, and you have ever looked for a deal or looked for assets, you're getting the emails. I actually wanted to start my own oil company in the powder in 2018, so I still get these EnergyNet emails. And these are, I mean, this is a staple in the industry. So we will talk about that as well. But before we dive in, just in case you want to cover any of this nerdy stuff and get your input, I know you're a very thoughtful person, so you think about this stuff in the space. But WTI is 85 and change. We're 85.46 right now. Brent is 88.41. And I caution folks a little bit there. If you are not thinking of hedging, you damn sure should be thinking about hedging right now, because these are incredibly good oil prices, and you could easily see this come off. You're going to see this come off. Yes, it could go higher, but the risk of the downside is much worse than the risk of the upside. And 88 and change for Brent tells you that we have very thin trading volumes, and that spread is too narrow. So I think we're seeing this September 1st, and this is Friday, right before the Labor Day weekend. Last week was, one of the biggest weeks where people don't work, where they call in sick, conveniently. And if you see if you see demand, everybody's like, yeah, the inventories are down and demand's ripping. Yeah, of course, the demand for last week was ripping because, again, that's the holiday period where you see gasoline demand up. And again, this correlates to people are working from home, quote, working from home, but they're taking, they're traveling on Mondays and Fridays, which I don't believe they're working very much on Mondays and Fridays. And that's exacerbating all this. So I think we could see some of that come off, and we can get into student loans having to be repaid this month. And there's some consequences that I think that could be actually for gasoline as well if prices are this high. But with that being said, Henry Hub is 281. So we're seeing a little bit of a tick up there. We and copper prices are 385. I've missed Dutch TTF. I'll have to look that up and come back to it. 30-year mortgage is 707, 7%. So we're still north of 7%. We have come off massively off those highs of 739 just days ago. That just shows you the incredibly erratic swings we're seeing in treasury yields and the interpretation of the market. If there's a little bad news in the market, little bad news in jobs data, or the jobs actually, unemployment ticked up today, so treasury yields are rolling back, and that gets everyone excited and thinks we're going to have a soft landing. I'm not sure about that. I think there's a lot of question marks there, but the 10-year yield is 417. So with that, that's sort of the timestamp. We do have lots of talk about the housing market, which I would love to get your thoughts on, and student loan repayment. But I think really right now, I mean, Chris, you have a wealth of knowledge. You run an incredible business. So maybe tell listeners a little bit, if you can give us a short intro, not a massive long, about EnergyNet, because I think a lot of people are familiar, but I'd love a short intro, what it is and what you're doing, what you're seeing in the marketplace, and we'll dive in then from there about the rig count and activity and everything going on.
Yeah, certainly, Trisha, and I appreciate you having me on. So I'm Chief Executive Officer of EnergyNet. Been with the company over 20 years. EnergyNet essentially brings buyers and sellers together to facilitate transactions. So we have really kind of three main areas of our business. We have our auction and sealed bid business, where we do some 2,000 to 2,500 individual transactions annually. These are lower 48, U.S., operated working interest, non-operated working interest, minerals, royalties, leasehold, combinations thereof. Some Gulf of Mexico, some Canadian assets, but usually those assets are say, $10 or $15 million in value per transaction. And then we have Indigo, EnergyNet Indigo, which is kind of our version of an energy investment bank or boutique advisory firm where we're doing kind of middle market transactions, higher value deals, more complex, more upside. So we do probably 20 to 30 of those a year that are kind of in a value range from 20 million to $250 million in value. And then the third area of our business is interesting. It's we facilitate government oil and gas lease sales. So we facilitate the Bureau of Land Management lease sales, university lands in Texas, Texas General Land Office, state of New Mexico, state of Oklahoma, state of Wyoming. So really interacting in all the major basins. And because of these interactions or these transactions that we're facilitating, we really, you name a company and they've probably bought an asset through the EnergyNet platform or bid on an asset through the EnergyNet platform or sold an asset. So we really have kind of a reason and an interaction with the full spectrum of E&P companies, large to small. So we've worked with Exxon and Chevron and Shell and Total and BP, but we've also worked with individuals that own minerals that inherited from their grandparents. And the full spectrum in between of private equity sponsored groups, family offices, true privates, and really gives us kind of a pulse of the market of things that are going on currently, or a timestamp in time, but also just kind of a reason to call on these and see their different drivers and motivations for participating, for acquiring assets, divesting assets, kind of their view on things. So a lot of the topics you mentioned today are front and center for us, just really on a daily basis as we advise our clients on acquiring oil and gas assets or divesting them.
Yeah, no, absolutely. And I think that's why, we obviously, we were chatting and we were playing blackjack. Fortunately that was fake money. But we were chatting, playing blackjack, and I was realizing, as a business, we have a lot of crossover in terms of the intel you're looking at. And you clearly are seeing a lot in the space. So given all that, you're seeing a lot. And, on your panel with the young man with NGP, you guys were talking about, the questions being asked were fantastic in terms of, asset allocation, how much are funds and how much are businesses actually, NC like NGP, how much are they actually getting in each of their funds and how much can they invest in oil and gas? And obviously that had been cut in half. It was like 5 billion had come back down to 2.5 billion. And this was just, in spite of, the profitability in the space. Obviously prices were not, at the time in June, were not $85 a barrel, but lots of stuff is really profitable. And I guess given all that backdrop that you just explained with your business and all that stuff that you see, can you walk us a little bit as listeners through, your perspective of sort of the pre-COVID to now, of how much this has changed? And I know I talk about this with listeners a lot on the podcast, but I think it'd be great to hear your perspective, how much, from your perspective of what you do, how much this has all shifted from sort of the maybe not pre-COVID, but COVID to now, how much life has changed and ESG pressure and everything has sort of impacted the state of the industry.
Sure, sure. So, kind of rewinding time and even past COVID to kind of, the advent of unconventional and shale and horizontal drilling and hydraulic fracturing, that really, was a whole new phase for the industry and unlocked tremendous amounts of value. The publicly traded E&P companies were, for a long period of time, really focused on, growing production, growing reserves, growing their NAV. They're outspending cash flow each year, grabbing resources wherever they could. And that was kind of a mindset that stayed with the industry until it really kind of broke the industry. During that phase of, say, 2014 to 2015, or 2014 to 2018 or 2019, there were the major private equity sponsors, the NGPs and NCAPs and Quantums and Denhams and KKRs, Blackstones, Warburg, hundreds of billions of dollars deployed into the space. They would raise funds, a $5 billion fund, $7 billion fund, $3 billion fund was not uncommon. Had lots, the private equity sponsors had lots of management teams. Some groups had, dozens in a specific basin.
Yep.
Which was very interesting. Relatively smaller teams. It was a resource grab. get out on the edge of Chevron or Pioneer or Oxy, and a little bit riskier dollars, a little bit riskier acreage, a little bit riskier technology, and unlock value and create great PUDs or create locations where they didn't previously exist, and then drill 2 wells and have room for 20 or 30 or 50 more and sell that to an upstream oil and gas company. The music really stopped. Just the industry, the public oil and gas industry upstream, really burned a lot of investors and burned through a lot of cash, and destructed a lot of capital, and that caused kind of a little bit where we are now. It kind of comes full circle. So many companies, they were never really returning profit to their shareholders in any shape or form. There were exits. The private equity sponsored companies had exits to publicly traded companies, and that was a big win for their investors. Or there were public to public acquisitions, and those were big wins. But at the end of when the musical chairs stopped, what had happened is that the generalist investor, or large institutions, pension funds, were really burned by the shale space. They gave a lot of that. The goodness of what shale did, it created low cost for consumers in terms of low natural gas prices and low oil prices for an extended period of time that really juiced the economy. But the investors at the end of it were kind of holding the bag. So, what's changed is just a new religion in the E&P space, where it's capital discipline, it's very moderate growth. What you'll see now, the E&P companies today are returning more cash to their investors than they're drilling wells or making acquisitions to some extent. So what's going on now, because of this kind of investor sentiment that turned so poorly towards the upstream space, we're never making any money. That's changed dramatically, and now with the E&P companies generating so much free cash flow from their operations, sending so much of that back to their shareholders in the terms of dividends or share buybacks, it's luring investors back in. It's not happening overnight, and it's it takes a while to rebuild trust, but it is happening, and it's really eye-opening to see that while the energy space may be only 4.2% of the S&P 500, it's generating like 2 times the cash flow of pretty much all the other sectors of it, industrials or telecom or tech, generating massive amounts of cash, and that's a big portion of that's going back to their investors. So it's kind of luring the investors back in. It's hard to watch how much money these oil and gas companies are making right now and not be enticed to I'd like to own some Oxy shares or some Chevron shares or some EOG or some Pioneer. So all of that's kind of creating this dynamic where we're kind of in a show me mode for investors, where they want to see higher prices. At the beginning of the show, you mentioned where we are with prices now. I think where they are now is kind of where the industry, like the executives and the management teams, thought they would be at this time. Almost all of 2023, I think the industry consensus on where WTI and gas prices and Henry Hub gas prices should be were considerably higher than what the strip was, what the future strip was, and that kind of had an impact. There was some selling that wasn't happening because sellers were wanting to hold on to their assets. In terms of private equity, some of these just in 2023, in the first 8 months of 2023, Advance is sold, Forge is sold, Taprock is sold, Novo is sold, Black Swan, Piedra, Petro Legacy, Percussion, Driftwood. All of these private equity sponsored teams have exited to publicly traded companies that are in search of inventory. The inventory is depleting. The locations are going away because those are being drilled. And for an E&P company to have longevity and sustainability from an investor point of view, they have to have some running room. So they've been gobbling up all these private equity sponsored teams. The sponsors themselves are now out raising new funds, and you have groups like NCAP, NGP, Carnelian, Kimmeridge, Warwick, Quantum out there raising new funds right now. The next iteration, once they raise those funds, it's going to be interesting to see how the game is played this time around, because it is a different world in terms of what it was between 2014 to say 2018 or so.
Yeah, that's an awesome recap. And you've given, I think, listeners a lot to chew on, and me a lot of points that I want to dive into a little bit more because I think it's a great recap and analysis, and I think there's a lot of components in there, especially in the consolidation piece that I think from where the state of the industry is at. I think firstly, I want to. There's a couple things I want to back into, and that's I want to make sure we eventually touch on this generalist investor and this investor sentiment and ESG pressure because I think it's critically important because I'm not with everyone in that I don't think that much money should be given back to shareholders. I Shareholders is one thing. Share buybacks is a completely different thing. And I think when we're throwing this much money at $85 oil into share buybacks, that's telling us that our valuations of our companies are not appropriate. And the fact that we're all these publicly traded companies are buying privates when they could be buying out, say, a Devon whose multiple
Yeah.
is crap. We have to start asking some questions here. And that also begs the question then of, what is the inventory story? I mean, we all talk about inventories and tiers, and I don't really, I've never bought it because when prices go up, not oil prices, gas prices are game changing. And we saw last year, really that's what drove everything. And actually, I was going back thinking about this podcast. I was going through the production and the rig count and just, want to double check myself because I'm always pretty bullish on the rock. And, I was looking at production levels in the Permian. They've actually held up pretty well. We saw, New Mexico come down a smidge, but if you look at the production, it's 1.7 million barrels a day for Lee and Eddy County. Just the Permian side of New Mexico is
Hmm.
1.7 million barrels a day. Yes, the decline curves have compressed a little bit, but on a normalized basis, you're talking 1,200 barrels a day. So I don't think that's not a horrible IP rate, regardless. And then you look at the wells are a fraction of the wells we've had actually in that in that number. And then we start looking at where the rig count is, and we've definitely seen that come off massively. So I think we can get into sort of activity and where we're going, and I think there's some serious implications for that. But I would like to talk about that sort of when you're thinking about that consolidation, and obviously we had the big ramp up, and the four guys starting an oil company, tons of them in the powder, tons of them in the DJ. I think in that panel you were on, you guys talked about everybody pulling out, private equity really pulling out of California and Colorado considerably. Just don't want to touch it. That's not a that's not an acreage thing. That's not a rock thing. There's inventory there. That's just them pulling out. So I think that's a little bit interesting. But then you think about, okay, we got rid of the management teams, and we have all this private equity. We have had consolidation in the space. And when I talk to clients, and when I work with companies or just talk to friends and CEOs in the industry, I think we're not really appreciating the impact on service companies. That this is the impact that this consolidation has had just this year on service companies, and especially here in Colorado. I mean, it's job losses immediate. When Chevron gobbles up a company, everybody thinks it's great for the basin. I disagree. I think that the bigger the oil company, the less they're going to drill, the less activity they have, and I struggle a little bit with. I really do struggle with the mantra of the. We tend to have a very positive sense of the industry, bullish on prices. I think folks have gotten lucky with prices going back to 85 right now. Very, very thin trading volume, as I mentioned. And then I think as an industry, yeah, all these oil companies are doing great. They're doing great right now because oil prices are great, but they're spending at $85 oil. They're cutting back and they're spending like at 60. So what the hell happens when it goes to 60? And that makes me anxious about where's everybody at? And I just feel like I can tell because I'm technically a service provider. How tight the damn industry is and how nobody's paying for anything. SPE, I mean, you name the entity in the organization that can't get funding from the industry, and it feels like the industry has left the intelligence space. They've left education. They're sort of just like making money and thinking it's really great, and I'm disheartened by it. But I'm also, I also hear this: we're running out of inventory, and you could have said we're running an inventory in 2021, and then 2022 happens and we have 650 gas for average for the year, and then everybody's wildcatting for gas. And oh, by the way, lots of condensate, lots of NGLs, lots of oil and gas drive that helps bring up that oil. And I think we're just
Yeah.
not appreciating how much of that gas prices actually really matter to oil activity. And
Oh
that's a
yeah,
lot
yeah,
of what we've
yeah.
seen in 2023. So sorry, that was kind of a
It,
rant. You can
No,
take.
but it is interesting, like on the OFS and service cost and the rig count coming down because and it's a interesting dynamic because the publicly traded companies aren't. I mean, they're paying for some upside and they're buying locations, but not really, not in the way that it was done before, where was acreage deals for massive amounts of money. If you look at some of the transaction multiples for the deals that have happened, especially publics buying privately held or private equity sponsored companies, the private equity sponsored company was mowing wells down, or were mowing wells down and drilling away and trying to get their production to the utmost peak it could be. And then at that point, they're doing a transaction and they're really selling for 2.5, 3.5 times cash flow. Oil and gas companies, because the publicly traded companies where they trade, they can't buy a company at 5 times or 6 times cash flow. They have to buy it, make it accretive to their enterprise value. So, if an E&P company, a public E&P company, is trading at 3.5, I mean, that's what you've seen a lot of the deals trade at, 2.5, 3.5 times cash flow, and that looks like a production value. But the privates are, drill, and then when the public buys them, they drop rigs, and they spread that, they make that inventory last, at this drilling pace longer. Yeah, I mean, the tiers of acreage and tiers of things will become more valuable. Tier 3 and tier 4 becomes tier 2 and tier 1 when oil prices at $100. But if you do look at some of the areas in Reeves County or in Lee County or in Karnes County or McKenzie County and some of the main oil basins, and you look at a map, you're like, where are they going to drill? Where are they going to put more wells? If you just see where how many wells have been drilled in those really hot active areas in Midland or Reagan or the counties, things like that, Martin County as well.
Yeah, I'm with you on that. And certainly when you look at a map, but if you go out there and you literally put yourself in Midland and you go out to the field, it feels a little bit different. Like literally on the ground, it's pretty spread out. And you realize,
Yeah, yeah,
okay, there's a lot here. And I always say I think that's different because if you're with an operator in the field, they'll tell you the same thing of, yeah, we have a lot of running room left here. And so I think we have to be careful about, and that's the trajectory, right? They can slow that down or whatever that is. And I think more for oil analysts in terms of like, how much are we actually adding? This is where a lot of folks, they get, gas analysts get it wrong all the time on gas, on what we can produce. And then I think on oil, and it's just interesting to me of thinking of, we may not have we're going to have iterations because, the privates will come in and they'll de-risk something, and then, the publics will come in and gobble it up. But and I think we're probably not thinking of not necessarily enhanced oil recovery, but refracking and just tinkering with existing wells probably a little bit more. We're probably not thinking of that quite the way we should. But
right,
no,
right.
your point's well taken, and it's heard. I think listeners know I push back on that pretty hard in terms of, I know we're definitely drilled a lot, and we have declining, that's for sure. But it's interesting because I think it was actually, I'd written this down in your panel. There was something that, I don't know if it was you said it or the NGP partner, he said it was like 10 to 15 years, the majors need that inventory. 8 to 12 years, the large companies like an EOG or something needs that inventory, and the 3 to 5 years is your sort of mid cap guys. And I thought that was interesting because it's something I commented with Dan Romito on the podcast last week. Is is that, it's just convenient that every, these oil companies throw out, and look, I buy and hold. So if people need to know, disclose my stocks. I
Yeah,
don't sell them, but I do buy and hold a small amount of oil companies. But like an EOG is funny. It's like they always have 10 years of inventory. They had 10 years of inventory 10 years ago, and now they have 10 years of inventory now. And I'm not ripping on EOG for that. I'm saying that's reality, right? They add, if the game is we need the inventory, trust me, a company
right,
like EOG does it through organic
right,
means, and they're going to get the inventory. So it's tricky to me to say, okay, well, everybody else is buying. That's also what the market's at. That's also what the market's okay with. So oil companies are
right. Yeah,
very, they're watching the investor pressure very, very carefully. I mean, they're crazy about the ESG stuff. This is where maybe we can get into the generalist investor thing a little bit, is that, they're watching this very carefully, and it seems okay. They don't get hammered when they buy these private companies. I'm pretty
right,
sure they would get hammered a little bit more if they bought a public company. And partly that's because that public company, it's easy for all of us to Google that, and there's that disclosures up front. I
right,
can't get access to all of that private company, all the NCAP back companies that Ovintiv bought. The average person can't just go grab the intel and scour that and rip it apart.
right.
So I think I know that's not the only thing, but I do think there's a little bit of something that, and we kind of all know in the industry, the valuations on this stuff is massive. If you
Well,
compare, Like what Ovintiv bought these NCAP companies for versus what you could have bought a public company for are the comps
Yeah.
are
No,
pretty big.
I agree, and I hear what you're saying about the EOGs and the the super majors and the super independents on their inventory. But if you do take a look at, and kind of back to your generalist comments, generalist investor comments, there are small mid cap publicly traded companies that they are eager to grow, to become more relevant. So
Yep.
they've been on acquisition sprees. Earthstone, for example, that they got bought. They're merging or being acquired by Permian Resources. But before that, they had just acquired Novo. A month and a half before they got acquired by or being announced that they're being acquired by Permian Resources. But the small to mid caps, Silverbow, Earthstone, others, they're trying to gain scale and get larger because from a generalist investor or an asset allocator at a big fund or pension fund, if they're going to allocate money to oil and gas or to energy, it makes more. There's not that much differentiator between, or there is a big differentiator. Like, why don't, if I have this many dollars to put in this bucket over here, why don't I just put it, in Exxon or in Chevron or in EOG or Oxy? Like, what the money's not going
Yep.
to being allocated to the small to mid cap public. So they need to grow. And they're, and from the perspective there, their inventory may be, it may not be as wholesome as it could be, or from a, looking at just looking at a map, looking at
Yep.
their rig pace.
No, and that's a really good point. And this gets us to this point of this general investor and this investor pressure. Because see, I think I call BS on that's why they're not traded well. I think the pressure on the mid caps and even large caps, and I love Oxy. I don't. I'm just saying the market's like, yes, I'm good with Oxy and I'm good with Chevron and Exxon. That's because these guys are playing the game really hard. And it's really, the ESG pressure and the investor pressure on the industry is massive. And the industry does not talk publicly enough about that and push back on that enough. And that's why, my conversation with Dan Romito on this is why I really struggle with all these ESG qualifications that we're doing when you don't have to yet. I think is super important that the industry should do everything right. I mean, I'm third generation oil and gas. I care desperately about doing things the best way possible. But going, throwing yourself over the barrel to, do more than you need to when, the whole point of this is if you give a mouse a cookie, they want a glass of milk. And I don't think
Yeah.
all these, requirements are because they want you to succeed and do better and thrive as an industry. Absolutely not. It's to put the industry out of business. And so I think we have to be very careful on these disclosures. But the reality is this, when I hear about this sentiment around these oil companies in the publicly traded space, and then you listen to the earnings calls and they're saying, they're talking about share buybacks, and it's like I understand why you're buying back share, and you're telling the street that you're not valued appropriately, and truthfully you're not. At $85 oil, these oil companies are not valued where they need to be, but that is because the generalist investor and the retail investor and everyone has pulled out of oil and gas, and no one loves oil and gas. And to me, that's because the oil companies are no longer telling their story. You can't go around waving the net zero 2050 flag around like crazy and talking about the energy transition. And then, oh, by the way, we're still going to be around 10 years from now. And
Right.
way more than 10 years, 15, 20, 30 years from now, they're going to be around. So this is less to me about inventory. That's a convenient excuse. It's more about your oil companies are no longer telling the street that they drill and produce oil, they make a crap ton of money, and this is a thriving market. And that they, I know that they struggle in terms of, in the space of the, getting in a management portfolio, dealing with the issue investor pressure. And I think that's why it needs to be talked about more, and we need to shed a light on how serious access to capital is. And that's something I want to talk to you about. Like, so on the investor side, and, actually being in these portfolios and getting touted, and, a sell side analyst, buy side analyst, it's really important. I don't think we have enough light on, the issue pressures, the disclosures, all the stuff that's happening, and the perplexities that these oil companies are in. But I do think they're not telling the street their story well of why
It
you
is. I
should
mean,
invest in
yeah,
oil and gas.
I totally agree with that. And I don't necessarily know the answer to it, but it is. I mean, oil and gas companies, really, for as long as I've been alive, have been vilified, and they generally are the big bad mean oil and gas companies. But then, but it all seems to me, it just seems hypocritical that that everybody has a modern lifestyle with their Starbucks and their vacations to somewhere exotic, and the air conditioning, and their NICU units at the hospital, or ICU units, or all the things that we fully expect, and DoorDash and Amazon delivery in 30 minutes. Modern life, is to this day right now runs on 80% of everywhere in the world is run on fossil fuels, and so there's a demand for it, and there's a consumption of it by people, by humans, and there's people in other areas of the world that would like to have a tenth of the modern luxuries that we have. So it's a difficult story to tell. I can see why political powers that be want to demonize it. But I mean, if I don't think that net zero by 2050 is remotely possible. I think it's all those people that promised it are going to be gone by then, out of their position. They can promise it now and wave their arms and say all the things that they're doing to move there. I just don't think it's realistic unless there's some technological breakthrough that we have another. I mean, oil was discovered. Hydrocarbons were discovered 200 years ago or something. That spawned the Industrial Revolution. It's not that long ago, but
Right.
it is there's not there's a disconnect in reality on like what we want our modern life to be and how we want it to be, and how that comes to be. Like the facts are that some many things in our society are reliant on uh, oil or natural gas for making nitrogen for fertilizer for all the food that we have, or transportation, or heating, chemical processes, plastics. There's lots of things that just that don't work with only renewables.
Yeah, and I mean, I think that's where I say it a lot, but I think that's where the industry just no one's gonna talk about the real side of the industry in terms of valuations, and that's why I think it's so incredibly important. Not just for, yes, we all need it, we're going to consume it, and as somebody who's grew up around the business and analyzes it critically long term, we're talking. I'm working 30 years out, 40 years out. That the critical need for high BTU, high energy dense energy is huge, and so renewables just don't provide it. But I think actually from publicly traded companies, there's a role here to talk about your companies and your assets in a more productive manner, to
Yeah,
really
yeah,
sell your
yeah.
story as an industry. And I think that there does need to be more light shed on to what exactly are these ESG pressures, how do they manifest themselves, and are there ways to hit the metrics that you need to hit, but also talk to the average person. That's why I say it's so important to have voices like mine out there, because there's just not that many people talking about this. There's really not
Right.
anybody pushing back and not calling them fossil fuels, because they are traditional fuels. They are hydrocarbons, they are crude oil, they're natural gas, and they're coal. And they're just not, no one's talking about the facts around them. But that being said, I want to pick your brain. Those are great comments. I want to pick your brain on, we've talked about this offline a little bit in terms of capital access. And I had lots of light bulbs going off when I'm a crazy entrepreneur and I want to do a gazillion things in life. But and I was genuinely interested in starting my own oil company and running it, because I mean, everybody's thought about that. You love the business. I'm sure you've thought about it as well. But access to capital is a huge problem right now. And that's something that, across, doesn't matter what conference you go to, who you're talking to, capital access is a problem. And that's so interesting, in spite of the metrics, how profitable the industry is right now, and how it's a really I didn't like back in the day when we had all the hype and we had the massive private equity money throwing in, and everybody and their dog had a company in the powder with a 4-person management team, and I've got 4 engineers together, and somebody came from EOG and we started an oil company, and then everybody's like, oh my gosh, it's amazing. And you drill the 2 wells, you blow them, or you rip them, and then you're like, hey, we got a little bit of acreage. And that model I didn't think was very good. It obviously didn't pan out, and we're where we're at. But I mean, in terms of I talked about this with Harold Ham on the podcast in terms of like the resource. I mean, the reason a lot of these companies have held on to their acreage is because they know they know they're going to go back and tinker with these wells. They they know this stuff, right? They have a long game, a long view in mind, and most people who've been in the industry do have that view. But I think capital access and alternative funding are really interesting to me right now. Is that, it does seem that it's harder to get money. Obviously, with
Hmm.
higher interest rates, that's a real problem. But with the ESG pressures and all these metrics to hit, the ability just to get insurance, I think, is one of them. But there's another whole element of people just aren't funding oil and gas. And so you have the private money that, people know about it, but they don't know about it really well. It's like you have like private equity, but then you have like, I think you have a couple different tiers of private money below that, of like the real just wealthy people that understand the business or are comfortable in it and want to invest. And then you have like private offices and stuff. And those are great. I don't know if I'll even those maybe in Texas are, while they're wonderful and I support them, I don't know if they're deeply knowledgeable about, the industry and the assets and everything. And I know you can get funding from that, but I'm wondering, one, your perspective on access to capital, because it does seem very constrained, and are there ways around this, and will this evolve, and that the capital comes back? And two, or maybe if we've completely shifted and if the ESG pressures continue, then we just don't have it. I mean, Exxon's mentioned this publicly now, and GP everybody sort of mentioned it. But then lastly or secondly on that, is that alternative funding. Is there an opportunity? Because, we've talked about this, hands up, ready to run the company. Is there an opportunity for separate funding to say, yes, we're critical, we're going to analyze the teams and everything, but just alternative funding that's willing to take a much bigger risk on the industry and doesn't is not subject to all those ESG and investor pressures that even the private money seems to be subject to, that is willing to take a differentiated bet. Seems like there's a massive opportunity there. Risky, but
Yeah,
opportunity.
yeah, most definitely. I mean, the oil and gas industry and upstream industry is very capital intensive. Many years ago,
Absolutely.
Aubrey McLendon, when he was when God rest his soul, when he was speaking at a conference, and it always kind of stuck with me. But he said, imagine we're not in the oil and gas industry. You're an entrepreneur. You're a young man or woman. You want to start a business, and your great grandfather says, I haven't told you about this. I was waiting until you turn 25, but we're gonna we've had this family money set aside, and we have $30 million that we're gifting you. You're inheriting $30 million, and that's great if you're going to start a technology company or a bookstore or a car,
Hmm.
automobile or something. But if you're gonna, Aubrey McLendon was like, Grandpa, that's only two horizontal wells and
Yep.
like 1,000 acres. Like I'm not going to get very far with that. So, and that was with like gifted money, but always kind of
Yep.
just like the amount of money it takes, and the pool has shrunk. So, the private equity sponsors in 2015, 2016, I mean, it was always $125 billion in dry powder. That's probably 30 or $40 billion in dry powder from the private equity sponsors. There are strings attached that those are the sponsors raise money from LPs. It's been harder for them to raise money because of ESG issues, because you know the thought that electric cars are going to take over the world. There's no longer going to need to be gasoline used for internal combustion engines, because there's not going to be any. Things like that, or just the general feeling that oil and gas is tobacco, and they're going out of business. So why would we invest in Sears if we can invest in Amazon? And that was a lot for many things, respects. Is still kind of a view of the industry. It's made it more difficult. There are groups that there are family offices that are funding oil and gas. They're not. It's not nearly as deep a well as other areas. I do think that with the capital discipline in the space and the amount of money that they are generating, it does. I feel like it over time it brings money back to the space. That if it can be demonstrated that this is the dollars, the profit that can be made from this industry, even though it is so capital intensive. In terms of, I mean, you look at a company like Hillcorp, for example, that has bought many of the assets from Chevron or from BP or from ConocoPhillips. They're a good steward of their assets. They're not, it is a public selling to a private, but they intend to own those. Hillcorp intends to own those assets
Right.
until they're plugged and abandoned, and properly the land is properly restored. And it's that they serve a niche in the market to be able to do that. But they probably made some really great acquisitions because we need the big company needs to get rid of this asset because it's the emissions are too high or the
Right.
risk is too high, and we're getting pressure from it from our investors. Hillcorp as a privately held company, or you mentioned Harold Hamm, Continental now as a privately held company, can be more thoughtful and rational about what they're doing and not bow to the winds that winds of the day. I would say that speaking out in the industry can be difficult for these the executives or of the publicly traded companies or private equity sponsored folks. They can try to speak the truth as much as they can, but they can also get a call from a big fund manager that says, well, you said this and you said the energy transition wasn't going to happen by 2050, so we're going to take money away from you. And that silences a lot of people, or that makes people parse their words a little bit more,
Yeah.
maybe not speak as openly as to what they believe the truth might be. If if you're going to say something and they're going to get penalized in monetary forms because of it, it makes it difficult. You have to be thoughtful about it.
Yeah, no, I mean that's a great point. And actually to me, I mean that's stuff that I see and feel every day, and I think that's why it's so serious that folks that can and that have the opportunity to be educating and talking about this, you have to have these voices out there, because the more that gets taken away, then the knowledge about just how the state of not just the industry but the economy in the world, and geopolitics, and if it's not there, then people don't have access to this information and they can't make good business decisions off of it. And so if you let the International Energy Agency, be the only voice for, and publicly traded companies who have to toe the line be the only voice for the state of the industry and the realities of investing, then you're not going to have accurate information. And that's just not good for day-to-day business. So I think there are huge implications to that, but that's a very valid point. But does that, so you didn't really answer the question, and maybe you don't want to, and that's okay. But
What is the question?
the alternative funding, is there you made the point very clear, and you're right. I mean, actually, I think even now with inflation, we saw a drop in the ability to drill and complete a well during COVID times, and slightly just after was fantastic, right? Until we had the inflation that we've seen across the world and everything. Obviously, we've had lots of inflation in the oil and gas sector, and folks like Harold Hamm have said publicly on my podcast that you need $80 oil in the powder to make it work. I think there are plenty of other companies that would disagree with that. And honestly, if you are not profitable right now at these prices, we've got some problems in the business. And that's maybe some tricky things there. But we've seen you could drill a well maybe for 5 to 7 million. Some really good wells at good prices now is probably 10 million with inflation in certain places. But and so we know that, right? Let's just say 10 million to drill a well. So your point about Aubrey McLendon talking about 30 million, getting acreage, drilling wells. I mean, this is expensive. You do have to have insurance. You have to have all kinds of things. So we know it's expensive, but is there still the interest, as we know in the business, is still massive, right? And we still
Mm-hmm.
know we even know from the public side, given that how much is still out there, that there's a lot of this interest. So I just wonder if there's a role for really being extremely thoughtful and extremely articulate about what you're doing, and trying to raise capital that is willing to is willing to push back and just say, we're here for the long term. Is there ability to do that, or is that sort of just, this isn't the time and place, an alternative funding structure? It's got to toe the line. It's going to have to go through.
No, yeah, I guess I misrep. I didn't understand it. Like, I don't think that there's big pools of alternative capital that are not public markets or private equity or family offices. I don't know if there's a deep. I mean, there's not a way to crowd fund this industry. But I do think that there's like what the publicly traded E&P companies are doing now, and it came through a painful place. Pain plus reflection equals progress. So like the new way that the oil and gas companies are being run, that they are focused on return on equity and on EBITDA and on running a profitable business, where maybe before they just wanted to get as much resources under their in their ownership as they possibly could at all costs. And like if the oil and gas industry, as it's been doing for the past couple of years, if it continues to generate the cash flow and the profitability that it has been, I think you have to have. I think it just people will see the reality a little clearer, that this is not going away. I mean, these companies, some companies right now are valued like they're going out of business. like they're going to, it's a blowdown mode, that they're going to be
Right.
out of their resources in a short amount of time, and they're just not going to exist and not going to have any revenue anymore, and they're just going to shut down. And that I don't think that's the case at all. But I do like this kind of show me mode from investors. It's there's been, or this year at least, there's been a looming recession, that's been looming. It's on the horizon. It's almost here. It's almost here. It's almost here, and it hasn't been here. And I do think the world economy has a lot of resiliency, and we keep chugging along. We keep using more energy in all forms, more than we did yesterday. Every day since existence, we've not used less energy than we
Right.
did the day before. We continue to use more and more. So unless that truth, I mean, the recession, the looming recession that's supposed to be here any day, that's what's supposed to tamper demand. I don't. I mean, I don't know. People, like when I drive around my town in Houston, or go somewhere else, it seems to be more cars on the road and more strip centers and more buildings coming up and more neighborhoods, going out farther and farther. It doesn't. Things don't seem to be shrinking to my eyes, but that's the worry, right? If it goes the other way, then I feel like that we're undersupplied, and then yes, the tier 3 and tier 4 acreage becomes more economic, and prices go up.
Well, and I think that's the perfect thing. I was wrestling with how to discuss with you with this podcast. I was wrestling with how to discuss sort of the economy and folding this with oil prices and sort of that with, because I also want to talk, touch on before we close a little bit on activity, because I was going through the rig counts and thinking, we actually have seen a considerable drop in the rig count. I was just baselining this and checking, where we peaked. And, U.S. rigs, the rig count in the U.S. peaked in December 2022, basically at 784 total rigs. And as we mentioned before, talking about gas prices, a lot of this was driven by very high gas prices, which really helped the oil company. So it wasn't
Mm-hmm.
necessarily just dry gas rigs going to town, but so 784 rigs, and that wasn't even touching the pre-COVID levels. We were
Mm-hmm.
still under that, but that's a pretty nice peak. That was December, so it took a while for everybody to back off, even though we had, the compression in oil prices. And so we've had lots of lags, I think, from reality of what oil companies understand the market to be, which is, think that's why I have a job, and then where the market's actually at, and understanding the economy and the trajectory. And this looming recession where the shoe hasn't dropped, it is creating a lot of confusion, especially right now with 85 WTI. And we can talk about that, because I would love to get some loop around with listeners with that. But so oil rigs peaked in November, and that was 627 rigs. They're now at 512. So just for that total rig, we went from 784 to 632. So we've lost well over 100 rigs in total. We've went from 627 rigs of oil rigs in Baker Hughes November 2022 now to 512. And now, gas rigs peaked in September of 2022 at 166, and they're now at 115. And you can talk to folks on the ground, and yes, you've definitely seen activity, really pull back in a lot of gas plays, certainly in the Haynesville. But it's interesting; it didn't pull back quite as quickly, and I think it was hard for a lot of service companies to really navigate that with the publics and privates, because as the privates were pulling back, very responsive to oil prices, the publics were adding rigs. They were adding rigs in a declining price environment, but they were, they're okay with prices. And then we have the whole duck problem, where we do actually have a lot of drilled but uncompleted wells, and then folks are drawing, they're actually just completing their ducks, or they're just waiting. We've had a lot of people just sit there and wait. And so the world post COVID is so much different in the oil market in terms of activity and, ducks, and when we frack a well. And that, I think it's increasingly hard for the average service company to navigate that. Also, that's why I find fascinating, because I love service companies, love working with them. They're but they're hard, because they don't want to pay for market intelligence, because and so they just sort of wing it. And then winging it, it never really works, but it's always fascinating, because they're interesting companies. But I mean, you see this across Permian, Haynesville, you name it. So we've lost those rigs, and then now if you're looking at this, you're thinking, okay, rigs are tipping down. And then the person would say, okay, average person on Twitter, average person, market commentary, stock market would say, okay, rigs are down, crude oil inventories are down in the U.S. Look at that stock drawdown you had this week. Look at the demand for crude oil prices last, the product supplied and the total demand last week. And that's great. But I'm not throwing cold water on I am throwing cold water on. We are in a recession. Most at least half of the economy is in a recession. What has skewed all of this is the critical lags from a stimulus. So we had so much money pumped into the economy during COVID,
Mm-hmm.
$27 trillion globally, that's still there's still a lot of that permeating through the system. And so it's artificially capped oil prices up. And of course, when you have a summer that's defined, when people talk about this, of Beyonce concerts and Taylor Swift concerts and the Barbie movie, and everybody driving and spending, and people again not working or working from home and driving, that's going to keep your gasoline demand elevated. Now, in a recession, gasoline demand does not tank. Diesel demand comes off a little bit and jet fuel comes off a little bit. And so it makes complete sense to me, if people are taking off time from work or not working or have flexibility to work, that they're driving and flying a lot. And so I think we may have seen, and I think that's a lot of question marks in the system right now, of when you have inflation, it tells you that people are spending and moving stuff. But we have a lot of that inflation because we had so much of this money. So I think we have to be very, very careful, especially those of us in the industry, of the moment we're in now and seeing how things look okay, to saying, drawing that out going forward. And we also have prices being artificially held up because the Saudis have willingly cut. They went from 10 million barrels a day this year. For the first time, they were going to be north of 10 million barrels a day on average in 2022. They cut a million barrels a day. They're 9 million barrels a day. They cut because they saw what was going on within China. The Chinese economy is in a I cannot underscore enough how bad it is. It is not beyond recession. Like they're it's hell in a handbasket, and we keep hearing these stimulus measures that are coming out, but they're trickle. And I think if you're on the ground in China, which we're obviously not, I think it looks a lot worse. Probably we're seeing on TV. So it is interesting to me just to hear folks in the industry, the perspective on this, and I get very nervous when oil prices go to 85 and everybody gets very bullish thesis thinking, and it's like, well, what drove that price up? And if it's demand cuts, and a little bit of that is because the Russians said they were going to comply with some cuts as well. Demand cuts are what we saw in 2018, right? Or sorry, supply cuts do not drive oil prices. So demand growth,
Mm-hmm.
to your point, we're not declining demand, and I'm not pessimistic on demand dropping, off a cliff. But driving long-term oil prices is, you need that demand growth, and we can have demand being steady. But I think it's also really critically important to think about the state of the economy, the state of the consumer, the fact that student loans, while it won't hit your credit, you have the interest is going to start accruing this month, September,
Mm-hmm.
which means you got to start paying back student loans. The average is almost $400 a month. And that means that $85 oil and inflation that we still have, the consumer has less money in the pocket than they did a year ago. And so $85 oil hurts more now than it did last year. And I
Oh
think,
yeah, yeah.
so from an inflationary perspective, it makes me very anxious that, the state of the global economy is not where it was, and we have less of that we still have those drags and stimulus. So I'm sorry, that was a rant. I'd love your perspective on that, and where you're
Well,
sort of
yeah, yeah,
thinking
a couple of
industry.
things. Yeah, a couple of things that like
Yeah,
the
attack
Saudi
away.
million barrel cut that exists out there, and it's important for everyone to keep that in mind, that can come back, at their choosing, and cool things. So I think that's something important. I remember in the my Thanksgiving was ruined in 2014 because I forgot
Yep.
that OPEC was still existed. It was just the shale industry from now, and they ruined my Thanksgiving. But beyond that, like on the consumer side, on the economy side, student loans are going to have an impact. We're repaying those. Mortgage rates, one aspect is
Credit cards.
we were so zero to no interest, zero to
Right.
no interest rates for so long. Um, you know, the fact that that a certificate of deposit can be, I can put my money in a certificate of deposit right now and earn 5.5, six
Yep.
percent maybe interest. And that should be pretty safe, I think. But compared to like buying a PDP oil and gas asset for
Yep.
PD10, it's
That's a
like,
good point.
well, which one
That's a
should
good
I?
point.
Which one is safer? Less like, am I appropriately paying for risk here if I'm doing that?
Yep.
So now
That's a
you've
very good
seen
point.
because of the interest rates, and the trying to tamper inflation with the Fed's policy there. I mean, it has caused producing assets to the values of those. I mean, it's not guaranteed. It used to be almost a given. Like my PDP is just going to trade for PV10.
Right.
where now you see a lot of transactions, trading for PD15, things like that, just because even if you have like a mortgage, a home mortgage is 7%. But if you can find a bank lender that's willing to lend you some money to help you acquire a PDP oil or gas asset, I mean, they're probably going to charge you 8 or 9 or 10% interest, I would imagine.
That's a good, I love that you pivoted on this because that's a really good point in question. And something I brought up that you might have a little more color on this is so interest rates and access that impacts obviously access to capital. And so your points on these valuations, like yes, it might be more valuable, but the cost of this and the risk is higher. But what about the regional bank access? So I can say, I personally, my money this year has been in a regional bank, and my business money, and that has made me anxious. So I drew that down immediately, and I've kept it drawn down. I even though I could get my money back if it's under $250,000 limit, which it's way under that obviously. But even though you can get your money back, it still hurts your business to not, if you don't have access to that capital immediately, and you need to be spending and stuff. So I do, and I've commented on this before. And if you're in Midland or anywhere else, and you see these regional banks, there's a lot of something, we talk about commercial real estate exposure to regional banks, which is huge and disproportionate, but we don't talk about oil and gas. That's probably because nobody cares about oil and gas, and it's so demonized. But we don't talk about oil and gas exposure to regional banks.
Yeah, I mean, spring break of this year was definitely interesting with Sovereign Bank and Silicon Valley Bank failing, but it kind of for anyone that's a libertarian, it kind of tests your views on things. If
Absolutely, absolutely.
the banks start failing, should anything happen, and I think the federal government said yes, we will step in and and save everyone and make them whole, because we don't want that to happen, and that would be bad for the population or politics or general things going forward. But there was like when all the Silicon Valley Bank collapsed, and there was liquidity issues, and other banks were jumping in to make them more solvent. It did flow out to the regional banks, and you have to think, and that's a pretty, in my head, where I keep my money in the bank, I think it's safe there. I don't. If I didn't think it was safe there, I would, that would be a whole other can of worms. But it is like kind of a peace of mind thing that your money's safe in the vault, whether it's there or not. But it just the mindset it is. So, yeah, the regional banks have a lot of exposure to real estate. I think it's winnowed down just on oil and gas. I think a lot of the companies that I know that are privately held, that have they all have long-standing relationships with their oil and gas lending with their banks. These are 10-year, 15-year, 20-year relationships with their bank, and based on production and reserves and things like that. So I think they're in good shape, but I think it is a smaller universe of regional banks that are having you know needle moving exposure to oil and gas.
Okay, I appreciate that. In this, there's a million more questions I could ask you, and we could continue this conversation. I think you've sort of encapsulated this pretty well. The final question I guess I have for you is that, given you've tipped your hat a little bit in this recession that's not coming, and I'm in the opposite side of that. Do you think where you're sitting, and I'm careful with this because I feel this run. If you don't feel it immediately, if you're not impacted by it, and you still see activity, and I'm curious this, especially in Texas, given things are look like they're going so good, is there a deep sense of optimism and sort of bullish market thinking in the oil industry right now from where you're sitting?
Yeah, that's a good question. Yeah, because yeah, I can only have my perspective from my viewpoint. But yeah, I do. It does feel it feels like it's kind of there is optimism, more so than maybe some other areas, or some other hard hit economic wise areas of the country or the world. But it does feel lots of A&D activity going on a larger scale. Companies valuations expanding, whether it's maybe slower than they would like, but they are expanding. New funds being raised, things like that. So I think there is optimism where, well, I mean, it's all perspective, right? We all in 2020 and 2019, we all kind of stared into the abyss and scratched our head and said, what's that, What's the, from Top Gun, the original Top Gun, what's the truck driving school? What's the phone number for that? Am I going to have to change industries?
Right.
So we went through that. So, in comparison, things are relatively positive.
So does it feel a little frothy?
I wouldn't say frothy, but I
Like
mean,
a little
I feel like it's,
2018-ish?
no, it doesn't feel that way at
Okay.
all to
Okay.
me. I feel like
Okay. I appreciate that.
it was like it was a waiting. It was like an impatience and
Okay.
impatience and patience. Like, so I feel like it's like kind of the impatience of how things should be to how things are kind of shifting in the direction, seem to be kind of playing out maybe as predicted
Okay.
for in
No.
in
Yeah.
my orb.
Yeah, no, that's great. I think that's I really appreciate you giving that perspective, and obviously I see it from I'm analyzing things from so many different angles.
Right.
But I think it's really appreciated to see how it's seen in the space. And I don't think I don't think it's viewed as frothy. I think, even at that conference, I don't know if you were there when Harold Ham spoke and stuff, and he was talking about how, the industry was very bullish for the next 2 years, and they had sort of pulled back on that. And I think that pullback was a little bit healthy. I'm not quite sure the service sector and everybody is aligned, and I think that's where the education needs to happen a lot. And I say education a little more liberally, but knowledge in the space, the service sector, the oil companies, everybody needs to be, getting as much market intel as they can to navigate this. Because I think days like today, where you have $85 oil and you're looking around and things feel good, it's easy to feel really good. And it also felt really good in 2007. It also felt really
Yeah.
good for most of 2008. And the
Yeah.
market it does look a lot like that. So I think that's a great perspective and gives me a lot to chew on and think about in future podcasts. So thank
And
you.
it was at the Petroleum Alliance of Oklahoma conference. It's great to see someone like Harold Ham that doesn't just fly in and fly out. He was there the whole conference. He was
Absolutely.
there in his Dockers and his sleeves rolled up. I saw him tasting some banana pudding and commenting to his wife that it tastes really good, banana pudding. He's like waiting in the buffet line with everybody. Just a real
Uh,
salt of the earth guy. It's nice to be able to know people like that.
Yep, I believe that was his girlfriend, and yeah, no, it was he. I had him on the podcast, and he stuck around, and then like I mean, he's been stuck. He's now around the country on his book tour.
Yeah,
So he
game
was just
changer.
in Denver, and he's back here for this Western Energy Alliance thing. But yeah, no, he stuck around, and it was nice. I think that Western Energy Alliance is the Petroleum Alliance of Oklahoma is such a unique organization because that was a incredibly unique event, and so there was a massive amount of optimism around the industry. My presentation was a little bit counter to that, and it was well received, but everybody kind of looked at me like, "Oh crap." So it was good though. I had a blast, and I got to meet you here, a lot of folks from EnergyNet, so that was great.
Yeah, well, thanks so much for having me on. This was a good conversation.
Awesome. Well, thank you so much. Really appreciate it, Chris. Thank you. We'll have you or somebody in your team back as well.
Okay, awesome.
Okay.
Thank you.
All right. Okay. Bye.